What's different now when it comes to these sell-offs is that the U.S. seems to be driving these declines right now. Given the prints that we've seen in the data, do you see this as a tipping point now?
Yeah, I mean, I think that's right. We're looking at what looks like a broad weakening in global growth, but that's really starting to show through in the US data. The problem is that the signs have been there for a while in the US. So manufacturing sector has been slowing for some time, and the PMIs have been below 50 for some time. The consumer's been holding things up, but we're now starting to see the labour market slow a little bit as well. The ADP numbers there looking fairly bad with some backward revisions. This Friday we'll see the payrolls numbers, and if that points to ongoing weakness, then the time for the consumer could really start to be up. And once the slowdown in the manufacturing sector rolls through to the consumer sector, as it often has in recessions, that's when you see a real problem looking forward for the US, and that is a real problem for the global economy. Should
we be worried about a repeat of the fourth quarter that we saw last year, or are these concerns overblown?
At the moment where we're seeing equities, they're pricing in still very good growth in the US, and that's simply not the outlook that is coming through in the data. So I think there is a bit of a reckoning point for the global markets here at the moment. Equities are saying things are okay. We're going to see a repeat of 2015, 2016 or 2011, 2012, where the Fed could manufacture a gentle, easy slowdown and then a recovery. It doesn't seem like that's necessarily the case this time. If we see that spillover from the manufacturing sector through to the consumer sector, then equities are just pricing in too good an outcome.
Isaac, there seems to be this tension between cheap liquidity coming from the central banks, but you have these deteriorating economic fundamentals. So how do you see that tension playing out in the equity markets?
Yeah, I mean, the reality is when the Fed moves from a tightening to an easing cycle, you get a compression in risk premia, the discount rate narrows in, and that does help push up equity prices in the near term, and that can persist up until the point when earnings growth falls below 0% and you get an earnings recession. It's very difficult for that narrow risk premia to outweigh the impact of an earnings recession historically. At the moment, it feels like we've got that sugar rush. Is it behind us? Possibly, if the upcoming earnings results look as bad as what they should be. There's been a bit of a boost over the last couple of quarters from analysts revising their forecasts lower and corporates giving guidance lower, and so expectations can be beaten. But when that really moves into an earnings recession, that can't persist. And so we're a little bit worried about that looking out over the next 12 months or so.
Well, you heard the New York Fed president say that if you look at the U.S. economy from the rear view mirror, things look okay, but looking ahead, it's murkier. So what are the biggest pressure points on the U.S. economy for the coming quarter?
Yeah, the really important thing here is, has what is a fairly obvious manufacturing recession or manufacturing slowdown started to spill over to the consumer sector? And the consumer sector has really been what's driving GDP growth and supporting GDP growth over the last couple of years. Obviously, there was a boost from fiscal policy, but that's rolled off now. So it's over to the consumer, it's over to the labour market. Historically, when you have manufacturing recessions, it does flow through to jobs growth, it flows through to slower wages. And one of the things that is really important to have a look at is underemployment in the US economy. You know, we may see the unemployment rate still point to some tightness, but more broadly underlying that is some real weakness in the underemployment levels. So I think the consumer sector is the part to look at in the services sector, and if that starts to weaken, I think that there could be a real re-rating in the forward-looking parts of the equity markets.